Good morning everyone and welcome to another RF Crypto video. Well, today's markets have gone down again below the $900 billion mark in terms of market cap. It's gone down by 5% with Bitcoin decreasing and making its way down back to $20,000. Ethereum is also down by 6%, making its way down to $1,000. However, there is some good news in the horizon given that a lot of the cryptocurrencies, especially the major ones, are in the green for the past 7 days. So we are seeing some steady recoveries, but it's still not enough to go back to where it was before the major crash. And the increases in the last week, they're not that significant. I mean, 1% for Bitcoin, 6% for Ethereum. One coin that is actually doing quite well is Solana. Even though it's down by 7% in the last 24 hours, it increased by 30% in the last 7 days. Similarly, Dogecoin, it's a meme coin, but it is doing quite well. However, the markets are still pretty depressed. We haven't seen any upward action or any significant action that would lead to the increase in the prices, which would indicate the end of a bear market. We are still pretty much in a bear market, and with all the problems going on in the world, with the crisis in Eastern Europe, with inflation and massive hikes in interest rates, we will see a lot of pain in the markets, and it will still be a long way to go before the markets stabilize and go above the $1 trillion level. Looking at the price of Bitcoin, it's pretty boring. It's trading laterally. Yesterday, the prices were around 21,300 and it was trying to break this resistance level. But as you can see here, the bears quickly got into the market and sold off a lot of its assets, and it pushed the prices back down to about 20,000. There were a lot of bears that bought at a low, and then when the price goes even a bit up, they don't want the prices to go even higher, because these short traders are leveraged positions, and if the price goes very high, then they will lose their positions due to liquidations. So what do? They sell their positions before the prices can go high, and they maintain their positions open, or they even make a profit if the prices are low. So what they do is they buy on spots at this low level, they buy short positions at this high level, and then once the prices are up here, they put downwards pressure, selling what they bought on the spot market. And that's why we see such massive red candles. We see one or two green candles, and then red takes over the market right away. So recession worries were roaring back into the spotlight for Wall Street on Wednesday, with equity futures and oil prices dropping as investors looked ahead to congressional testimony from the Federal Reserve Chairman Jerome Powell. And now what's pulling back the market doesn't come as a surprise, because the rebound that took place on Tuesday was nothing more than an oversold bounce. So there was a rebound, the stock markets went up by about 5 to 10%, and nothing much was drawn from that. There wasn't much excitement because these analysts knew that it was just a bounce. It was just a temporary mechanism whereby there was a lot of buying so that then they can make easy profits. And Morgan Stanley's chief US equity strategist, Mike Wilson, basically said that the bear market will not be over until the recession arrives or the risk of one is extinguished. So usually what happens when there's a bear market, there's a recession and then there's a boom afterwards. Or what can happen is that all these risks that are plaguing the market, including and most importantly the conflict in Eastern Europe, if that gets resolved, we will see a massive bounce in the market, because then the upward pressures in oil and food and everything else that is driving inflation will cease to exist, and the prices will drop significantly, which would drive up demand due to the fact that everything is cheaper. Economic activity would pick up through consumption and through investments, and as a result, the equity markets would bounce back very, very strongly, as well as the GDP growth would go above 5%. The stock markets are falling, but money was flowing into traditional havens such as bonds and the dollar. And this makes sense, simply because bonds were always seen as a safe asset, and in times of turmoil, people turn to safe assets because they're scared to invest in stocks that are dropping so significantly that they'll go back to bonds where the prices are relatively stable and it gives out regular coupon payments. As well as they not only invest in bonds, but the dollar itself. What they mean by investing in the dollar is that they'll sell off their stocks and they'll take the cash and leave it in the bank or in a fixed deposit. So that's investing in the dollar. And this is why the dollar has become stronger. On other news, Joe Biden is expected to call on Wednesday for suspending the federal gas tax. So there is a federal tax on a gallon of gasoline in the United States of 18.4 cents per gallon, and the US President Joe Biden wants to temporarily suspend it or give a tax holiday. And this is due to the fact that the United States is now struggling to tackle soaring gasoline prices and inflation. So the inflation rate in the US is very high, over 8%. And this is mainly fueled by the price of gasoline and the price of other fuels, due to the fact that the conflict in Eastern Europe has made the prices of oil skyrocket. And the Federal Reserve has tried everything to control this. They tried increasing interest rates, they tried buying back assets from the public, or in other words, slimming down their balance sheet, but nothing has seemed to work because inflation rate has been above 8%. So what the president wants to do is decrease the price on gasoline in order to tame inflation. So their rationale for this is that it will offer real immediate relief without compromising the federal government's ability to make infrastructure investments. And they have tried everything to pull the prices of gas down, including the release of barrels from the US strategic reserves, waivers on rules for producing summer gasoline, and leaning on major OPEC countries to boost output. But nothing has seemed to work so far due to the sanctions in Russia and a squeeze on its refining capacity. So the next step is Joe Biden wanting to suspend the federal gas tax. And not a lot of people are happy about this. For example, Target's CEO says that we have a classic supply and demand challenge, and in all due respect to a gas holiday, it's only going to fuel the demand. It's doing nothing to increase supply, so it's only a temporary fix. It's like a mini stimulus. It won't work in the long term because it is just a band-aid in a massive wound. What he suggests is that it's time to fundamentally change the supply and demand curves for fuel and transportation, and a longer-term solution would be getting out in the oil fields and figuring out what needs to change, how to incentivize more production, because there is a supply and demand problem. There's a lot of demand and lower supply, and decreasing the price of gasoline will fuel demand, but in the short term. So what needs to change is not on the demand side, but on the supply side. In order to tackle the growing fuel prices, there needs to be an increase in supply so that supply matches demand or is higher than demand, such that the price of oil, which is the natural resource used to make gasoline, drops. And he's completely right. This gas tax holiday will only offer short-term resolve. We need longer-term solutions. Completely correct. So inflation is not only hitting the United States, it's also very, very strongly hitting the UK. A lot of people don't talk about it, but I think it's important to talk about it, given that the United Kingdom is a major economy in the world. Inflation in the country hits a 40-year high of 9.1% as food and energy price surge persists. So the largest upward contributions to the inflation rate come from housing and household services, primarily electricity, gas, and other fuels, along with transport. And this makes sense, right? If the price of oil goes up, the price of fuel goes up. If the price of fuel goes up, then everything else goes up because everything needs to be transported. So anything in your supermarket's shelves gets a price hike, the fuel that you put in a car gets a price hike, and transportation costs also go up. But in order to combat this, the Bank of England, which is the central bank of the UK, implemented a 5th consecutive hike to interest rates because they want to tame inflation without compounding the current economic slowdown. They want to increase interest rates, but they don't want to go into a recession. And this is very tricky for the UK because their economic growth rate is already relatively low. And due to the fact that it's low, they can't afford to increase interest rates. Because what happens when you increase interest rates is that your economy slows down because demand slows down as money becomes more expensive. So they're between a rock and a hard place, basically. And things are becoming very, very difficult to the average citizen of the UK because a recent survey showed that a quarter of Britons have resorted to skipping meals as inflationary pressures and food crisis conflate in what Bank of England Governor Andrew Bailey has dubbed an apocalyptic outlook for customers. And this is very, very sad. An industrialized, highly developed country like the UK is having a quarter or 25% of its population skipping meals because of incredibly high inflation and because of conflicts around the world that are out of the layman's control. Not only are food shortages and the energy crisis due to the Eastern European conflict driving prices up, but the UK has also navigated domestic pressures, such as the unwinding of the government's historic pandemic-era fiscal support, which means that during the pandemic they lowered interest rates and they started injecting money into the economy in order to stimulate the economy. But they need to unwind that. They need to undo their balance sheet and they need to increase interest rates in order to contain this inflation. And it's not so easy because economic growth rate is low. Also recently, there has been massive strikes in the railway stations, and now railway workers are abstaining from work because they want increases in their salaries due to the fact that inflationary pressures are putting a strain on their pockets. And it's the biggest strike since the 1970s. So let's see how the UK manages this, because it is a very, very difficult position that they're in. So the Bank of England has a lot of work in its hands. So Colombia's president seems to be a fan of Bitcoin. So the president-elect, Gustavo Petro, took on social media in 2017 to speak about the strength of Bitcoin. He hinted at a time that cryptocurrencies like Bitcoin would remove power from the government and traditional banks and give it back to people. He is also a leftist, or more liberal, and will join other world leaders who have enacted policies or otherwise spoken in favor of crypto adoption, such as in El Salvador, where Bitcoin became a legal tender in September 2021. Also, in April 2022, Panama's legislature approved a bill that would have created a regulatory framework for crypto, but its president partially vetoed the measure in June due to anti-money laundering concerns. However, when all those concerns are ironed out, I think that the legislature in Panama will pass this bill into law. So it will be interesting to see how Colombia adopts cryptocurrency and what the future steps are. So Tether is set to launch GBPT stablecoin pegged to the British pound. What they say is that they hope to help lead this innovation by providing cryptocurrency users worldwide with access to GBP denominated stablecoin issued by the largest stablecoin issuers. And they say that they're ready and willing to work with UK regulators to make this goal a reality and look forward to continued adoption of Tether stablecoins. The company's chief technology officer pointed out that the United Kingdom is a major location for the next wave of industry transformation. The announcement that they'll create the GBPT also states that the HM Treasury in April 2022 announced plans to make the country a global cryptocurrency hub and bring stablecoins into its regulatory framework. And I think that because the UK wants to create a framework not only for cryptocurrency but for stablecoins, and usually the UK law is very solid, this is the reason why Tether is investing in creating a pound-denominated stablecoin. It will be interesting how it's implemented. It will also be very interesting to see what people are allowed to do with GBPT and how it will be regulated. Hopefully, it's correctly backed by one-to-one reserves, so £1 reserves for 1 GBPT in circulation, so that the peg is always there and it's safe and secure for consumers to use. So that's it for today's video. Thank you very much for watching. If you enjoyed the video, please hit the like button, hit the subscribe button, and share this video with your friends and family. Invest wisely, and cheers.